Hey guys, okay, it's 2026, somewhere midway through January. And so, of course, a lot of you guys are thinking about buying a house, and I want to talk to you a little bit about rates. I've gotten a few questions from people so far. They say, hey, do you think it's a good time to buy? Do you think the rates are going to go up and go down? So I did a little bit of research. That's why I'm doing this in mid-January, just to see where the market experts in mortgage and the rate experts are saying, where are we in terms of rates and whether it's a good time for you to buy. But first, I just want to let you guys know that I got new things coming this year, and I hope it'll be some exciting things to help you guys in both credit and funding, but we'll talk a little bit about that later. So first of all, I just want to tell you guys, stop waiting for rates to go down and save you from higher payments. I'm going to put it to you that way, because that's not a real strategy. And, that's sort of a kind of a hope and pray strategy. As of this video, when I was checking, the national average for a 30-year mortgage was 6.16%. Now, that's progress from where rates were a couple of years ago when they got really high. They were in the 8s, high 8s, low 9s. And so, obviously, that's important, but that's not where your focus should be. Now, if you do have a current mortgage and you're thinking about refinancing or buying a new home, but if you're refinancing and your rates are above 7%, this you want to pay attention to, because obviously you want rates to be better than where you were when thinking about a refinance. So my mission for this video is real simple. I just want to want you to make a smart decision in a world where rates are below 7% for the first time in a couple of years. Now that's pretty good, but that's still not considered cheap in the big scheme of things. So what I'm going to cover is the rates, why the rates are where they are, why aren't they lower? Because a lot of people ask me that question. They ask about rate cuts and things like that, and they say, why aren't they lower? But the real question is, should you buy? Should you wait? Should you refi? Should you wait? And more importantly, just as important is 30 years versus 15 years. So, and if you have any questions, feel free to click the link that's in the show notes or the description. Book a call with me and I can talk to you about your particular situation firsthand and tell you what, find out what matters to you and tell you what's most important for your situation. So, first, let's talk about purchase. So the average is, like I said, 6.16 for a 30-year, 5.5, about 5.5 for a 15-year, so on and so forth. And of course, there's different rates for jumbos and all that. You say, okay, that's fine. Those are just numbers. And then there's numbers for refi. Refi's mortgage rates are a little different. But again, you say, okay, those are all numbers. What does that mean for me and my payment? These are averages, right? Okay, could be higher, could be lower. Now, your personal rate is going to depend on your personal credit file and scores, your down payment if you're purchasing, or loan to value if you're doing a refi, your debt to income ratio, and the lender's pricing that they're offering, because it could be, it's built on the market rates. So, in essence, two people can apply for the same loan on the same day and get different loans and get different offers for loans based on their different situations, scenarios of all those things I just mentioned. So the first thing, I'm going to say not the first thing because I had to think about that for a second. I'm going to go this way. The second biggest question I get, because the first question is usually, should I go now or should I wait? But the first question is, people say, well, why aren't the mortgage rates dropping faster than they are? I heard on the news that the prime rate went down. I heard the news that the fund rate went down. And I heard on the news the discount rate went down. So they said, Didn't the Fed cut the rates 3 times last year? I said, yes. They said, then why aren't the mortgage rates lower? And I tell them, I said, it's because the mortgage rates are not based on the Fed rate. That's the rates that banks charge each other when they borrow money from each other back and forth. Mortgage rates are tied to the 10-year Treasury yield. That's a totally different measurement. It has nothing to do with the Fed. It's all about the Treasury. And actually, that's only one piece of it. The rates are dictated by that. They're dictated by what the investors who buy these things called mortgage-backed securities, when they group all these loans together and sell them, and how the market individuals feel about things like inflation, other risks like battles, war, the recent events in Venezuela. Sometimes that has an effect as well on rates, and just like it has an effect on things like oil prices. So basically, the Fed is only one ingredient in this whole mix, but it's not the main ingredient. It's really the Treasury rates, and inflation is the wild card. So if you're thinking about buying in 2026, stop asking about, will rates drop a lot? Don't think about that, and start asking, can I win with the payment that I can afford, my own personal economy, and the home that I actually want and need? I mean, because the point of the whole thing is that rate is this. As I read a summary, they all pretty much said they expect rates to stay relatively stable where they are right now. They don't anticipate any wild swings, any sharp rises, or any crashes in the rate. So if your decision should hinge more on the home price, your needs, so in terms of like neighborhood prices, where values are, and your finances, your personal economy, more of that than the chasing rates. Okay, so a checklist that I recommend that you have is that you shop at least 3 lenders at minimum, that your real payment. In other words, either using a calculator online, there are some of those, mortgagerate.com. You want to calculate the principal, interest, taxes, and insurance. Those are the 4 main core items that will be in a mortgage typically in a mortgage payment. Now, if you're putting less than 20% down, you will also have a piece called the either mortgage insurance, basically, whether it's private insurance or whether it's government insurance through FHA. And you should also want to be clear that you want to fix the parts that you can control, like your credit, your debt to income ratio, and your down payment. Of course, credit being your credit score, your credit profile, which will improve your score. Your debt to income ratio, the amount of debt you got divided by your qualifying income. You want to make sure you're not overloaded with debt so that you can handle that mortgage payment. And of course, the more money you put down, the less you have to borrow. The smaller the amount you borrow, is smaller loan, the smaller the payment's going to be as well. So, talk about refinance real quick, because there are some people out there that are asking about refinancing because of the rate situation. I would say right now, if your rate is at least 7% or higher, if it's at least 7, maybe you might consider looking into a refinance if you have more than 20 years left on a 30-year mortgage. If you're halfway there, it may and your rates are not super high, it may not be worth the effort to do so. But again, it's always a good idea you can get that looked at either by me or a mortgage loan officer that you may be interested in. If you don't have someone you can go to, contact me, and I can definitely refer to some of my mortgage lending partners who I work with on a regular basis, that they can definitely help you make that decision. And if your if you're currently, as of this video, on your way waiting for a scheduled closing for a refinance, ask your loan officer about lock options and see if they could possibly float down that rate if you haven't already locked in a rate before the rates kind of dip down a little bit. So you still have, even if you're in the middle of your transaction, you still got some options. If you got a good loan officer working with you, they can certainly accommodate you and advise you on how to do that. So if you are thinking about refinance, which of you out there should really care right now? So if your current mortgage is 7% or higher, of course, that, today's ranges might save some money, but it's all about the numbers. So the reality check that you want to make if you're considering a refinance on your current mortgage is, what's your current rate? What would be your new rate and APR that you would be eligible for, and more importantly, being offered? What are the closing costs involved? Do you want to burn up a lot of equity just to get a rate that's not substantially higher? Substantially lower. How long you plan on staying? If you thinking about moving out of your house in 5 years or less, you probably don't want to be refinancing. You definitely don't want to be refinancing, and because in that calculation, you want to figure out, when you consider the new rate and the closing costs, how many payments before you break even on where you are now. So it's always a better idea to look at those numbers as a whole. Again, myself or one of my mortgage partners, we can definitely run the numbers for you and help you make that decision. So, but if 2 years or less, and your break even is 4 years, that refinance might be cute, but it ain't smart. So I would leave that alone. So let's talk a little bit about 30-year versus 15-year. If you're buying and you're trying to consider whether you want to do a 30-year or 15-year, obviously with the 30-year loan, the longer term, you're going to have a lower payment, but you may pay more in the long run. For example, on a $200,000 loan, let's just say, okay, if you did a 30-year and you got an interest rate about, say, 6.23, somewhere around there, that would give you a payment of about $1,228.83 a month. That's just the principal and interest part, not the taxes and insurance, because we're just talking loan money right now. So on that loan, 30 years at 6.23, about $1,229 a month, and over the life of the loan, that's $242,380. So almost $250,000 in payments, in interest over 30 years on a $200,000 loan. Now, same loan on a 15-year, rate's only going to be, it's going to be a slight smaller because it's a shorter term, right around 5.6. And so that's going to give you a principal and interest payment of about $1,648 a month. So quite a bit less per month, quite a bit more per month than the 30-year, but the total interest on that whole loan is only $96,000, give or take. So you say, oh, that's a lot less money, but if you're, but some people may not be able to handle that extra $400 a month in their budget. Sometimes they do, sometimes they won't. So yes, the 15 years saves a mountain of interest, but you have to carry that heavier payment and that heavier weight. So what do you do if that $1,600 is too much, but you don't really want to save money on that 30-year and that $1,200 payment? I would recommend that if the 1648 feels tight, just go with the 30-year and keep your flexibility. Then you can go ahead and make principal only payments extra to help pay down that balance faster and save on that interest. Now, it's important that if you're going to do that, Even if you only plan on doing it for a short amount of time, the most important time to do it is at the beginning, where you can save the most interest. Now, I know some of you out there, and because I've seen it, and I was scratching my head, and I'm like, this person didn't do the math, where they're saying that making principal payment, extra payments on your mortgage to save interest doesn't work. And they're talking about they've seen amortization tables. Well, guess what? I've seen amortization tables, and they say the opposite. You can see exactly that you're saving money and by paying your balance down faster, especially in the beginning. And just for you guys out there to know that same trick works with any installment loan. So whether it's a mortgage, whether it's an automobile loan, you can save a lot of interest and pay down your loan faster by making principal payments, principal only payments, assuming that you got ample savings set aside and that you got some investments set aside, because those are also good uses of that extra money. But we're talking mortgages today, so saving on interest, that's the way to do it. So, I mean, because at the end of the day, you don't want your mortgage discussion to become a hostage negotiation. So, for 2026, let me give you a little bit of an outlook as I see it. Okay, rates are not going to be in a free fall. They're going to be about where they are now. So, you might as well set yourself up for a steady glide yourself. The forecast suggests that rates are going to stay right in the 6% range. Now, I'm not sure if that's between 6 and 6.5 or between 6 and 7, but if I take what they say literal, it's going to be in 6 point something. So don't be concerned about waiting to see if mortgage rates are going to drop. If all your ducks are in a row to buy, go ahead and prepare to buy. Be prepared, but you want to do things, be prepared. Make sure you have your money for down payment and closing costs. Make sure you got your credit optimized. So number one, you won't have any issues with rate and with pricing and with interest and with terms. That's number one. And then number two, you don't want to have issues on your credit that are going to create problems in underwriting with, collections and things like that got to be fixed before they'll give you an approval. So you want to make sure all of that stuff is addressed, and at least find out whether it's an issue or not. I think any and all things on credit should be clean, because the cleaner your credit, the higher your score. The cleaner your credit, the less issues that decision makers have to be concerned with, less explanation letters or getting things cleared. But whether you have to have it cleared or not, you should know that before it gets to underwriting. So that's number one. So that's that on that part. But have all your ducks in a row, and then that way you'll be good. Now, there is some indication that it could see dip down below 6 near the end of the year, but I wouldn't count on that. And that was real skim, and they were talking about some complex banking things that would impact that stuff that you don't want to hear about right now. But keep that in mind. So if you're ready to buy for all the other reasons, do it. Don't hesitate, because if you're afraid that rates are going to suddenly drop. You can get the best rates possible if you got your credit together. I can't stress that enough. So don't build your plan on a dramatic drop. Build your plan on what the parts you can control. Like I said, credit profile, down payment, debt ratios, all of those things, and then shopping. And so that way you'll end up with a payment that you can live with, a payment that you can breathe with. So basically 6.16 is where we are. Okay, it's not a miracle, but it's pretty good. It's not bad. I mean, I would look at it as a window of opportunity from where we were before. But nonetheless, it's where we are right now that can get you into a house now. If you want to be in a house now is the time. Now, I got more to say on this video, but I'm trying to keep these videos short. So if you want a part 2, I'll break down 3 ways to lower your mortgage payment without waiting on the Fed, because the Fed doesn't matter. We'll be more like waiting on Treasury, but we don't want to do that either. But what we want to do is move your needle. We want to have your personal economy together. So if you want more ways on how to negotiate that, drop comments in there, and then I'll put that video together. But I have some other stuff I'm going to talk about that. So, you know, if you comment lower rates, and then tell me, you know, whether you're ready to buy, wait, or refinance, I'd like to talk to you about that as well. So, and if you want a personalized scenario breakdown on your situation, you know, if you want to drop your credit score in there, I don't blame you if you don't. But if you want to drop in there, click the link. Best thing to do is click the link, book a call with me, and then I'll go ahead and talk to you about that and tell you, you know, what to do, and whether you need to do anything extra, and see where you kind of land at right now if you were thinking about it. And basically, I'll tell you about what matters most in your situation. So I hope you guys like this video. If you're not already a subscriber, please subscribe. That way you'll get the notifications. And if you please like and please comment. I hate to ask you to do all three, but at least do one of those. At least do one of those. I think if you subscribe, you'll get the notifications. That'll be sweet. But at least do one of those. Doesn't cost anything to subscribe. And share. Please share with others you think might, you know, benefit from what I have to say about these things. If you know people that are thinking about buying, please do that as well. So, until the next video, talk to you guys soon.